So today I would like to talk about default probabilities, and therefore we will start to deal with chapter 19, and first we will check default probabilities, so how does it work, and after that we will deal with CDS and CDS pricing and everything which is related to CDS. Because as we can see that CDS has many myths, but also at the same time this is quite simple, or we can make it much more simple. So practically we have to work with tables and convert back and forth, but it's really a straightforward process. Okay, so credit ratings. So mostly they are defined to describe the credit quality of the agents or companies or states, as you learned already at International Financial Management. So they are trying to describe political risk, they are trying to define corporate specific risk, economic risk, and financial risk, and other risk, macro level or micro level risk influence on on the probability of default. But also at the same time we can see the ratings, so they are not providing an exact p-value for the probability, just they are highlighting future estimations, and also we can see that until the rating is stable, then we can say that the creditworthiness is stable also on the long run. If it changes, then it shows us that something is not great. But also at the same time, even companies rated in AAA category, they can go to default. So there is a chance always. Just the mass or number of these companies are relatively small. So yeah, business cycles. So usually ratings can follow business cycles, except when the company is counter-cyclical. So if the demand is stable, or at least or maybe increasing if there is a recession time period. And okay, so this is what I mentioned already. So how many companies are going to default, or in this case the percentages of companies which are going to default within a defined time period. And we can see that, okay, if something is rated AAA, then for them, even at a 7-year time frame, we cannot find it that it would go down. Otherwise, if it's AAA rated, still we can see that 0.5% can go down within 7 years. But after that, if we are going to the B ratings, we can see that yes, this number is increasing. So most of the defaults are obviously happening in the riskier non-investment grade categories. So that's why we can say that yeah, the first 4 part are the investment grade, and the next.
For triple C?
Yeah, for triple. I think that because they die immediately and after that. So I think that in a C categories, it's really hard to survive. So until and remain in C. Right. So they are going down within a year, or if they are able to reconsider or consolidate themselves, they are going upwards. But if not, then I think that sooner or later their struggling will take losses. So it's, you have to struggle a lot to survive in triple C category for 7 years. Maybe it's possible, just we can see. Yeah, the question is that yes, the total. So it's not supposed to, because if you are checking the So as you can see here, so there are a number of defaults. Maybe I was using different, okay, but maybe the report was changing, but otherwise we can see that, yeah, here there is 1%, and obviously the numbers can increasing because I think that these are just specific years. So because there is also some company which is missing, but yeah, this is a big question, that what just happens here, that if we are summing them up they are not, yeah, captured multiple times.
Yeah, they're different.
Yes.
It's 7 years in
Yeah.
the row, not the column.
Yes. Yeah, just in this case it's quite misleading to say that it's a, so in this case they should remove the total here, because this total here is okay, because if we are adding these numbers together, then at least it's reliable to assume that they are appropriate sums, but this is, so all the locations here, but we cannot add them together. Yeah. Okay, so this can be the reason behind this, and that's why this hazard rate can be computed, because if we know that, okay, what is the percentages of defaults, then practically the average hazard rate between time 0 and time t, this is the lambda, average lambda t. And this will come back later on when we will talk about CDS pricing, because if we are doing the math, then this will give us the probability of default. So from hazard rate, empirical hazard rates, we can generate some probabilities, which is quite a romantic assumption, because with this approach we are assuming normal distribution. So defaults should happen randomly if we are using this equation here, which is not the case when we have systemic crisis situations, which can generate much more defaults instantaneously. But okay, so the whole book uses this assumption, so let's keep it this way. And next thing, which will be important for us, that what is this unconditional default probability? So practically if we are taking the 3 years minus 1 year hazard rates. So after that the book not uses this term, so we are just defining it. Probability of survivor, yes, practically we can compute it backwards. So just if they are not going down, then they survive. Conditional default probability is practically the unconditional default probability and probability of survivors ratio. But it was also not appearing later, so okay. What is important for us? Recovery rate. So okay, even if the company goes down, usually their bond price is not zeroed down. So still the market participants can assume that, okay, maybe there will be a haircut, maybe they will have the debt during the consolidation, or when they are doing the negotiations at the after declaring the state of bankruptcy. But after, if the company survives, or even if they are eliminating the company, still some part of the debt will be repaid. So that's why it can be really important, but it depends negatively to the default rates. On the other hand, recovery rate is this thing, or we can assume that the situation will come from the numbers here, but Yeah. Okay, so what is much more exact? This is credit default swap. So in this case, we would like to insure ourselves against the risk of default. So practically, if we are taking a long position in a bond, and also at the same time we are buying an insurance against the default of this bond, then okay, we have to pay some fee as an insurance to do this. So practically this will be the total amount paid per year number. But after that, if we are doing this, practically we have some kind of artificial risk-free rate, because theoretically the credit default swap eliminates this kind of partner risk. Okay, we can say that this is not perfect, because obviously the counterparty's default probability will be absolutely added to this. So this is what people forgot before 2008, and after that the US government had to consolidate the EIG, which was the biggest insurance company in the US, because they were thinking that, oh, CDS is like another insurance business, because yeah, things are happening randomly like in other insurance businesses, so we're just collecting the fees, and if they are burning down, then we'll give them then. And after that they realized that, yeah, but in this case there are catastrophic scenarios, and we know that in catastrophic scenarios insurance companies can do a thing. So that's why we have a state. So if the whole city is burned down, then insurance company cannot pay out everything. So they are also defaulting, like what could happen in a bank run also, that they are not able to liquidate their asset side so fast to pay out all the clients, or even they can do it, but after that the company will cease to exist because they are running out of assets. So but the same thing completely can happen in during a financial crisis, especially that this is not written by the book, but this is an important thing, that you don't have to have an underlying asset. So you can say that, okay, I'm buying a CDS, but you don't supposed to have any kind of bonds. So one motivation can be that I would like to have risk-free interest rates. Other motivation can be that I would like to trade risk perception, practically. So if I would like to trade in with the greediness or the level of afraidness or risk sentiment of the market, then CDS is the best option. But it means that the positions in CDS can exceed the set of bonds. So practically they don't have to be parallel. So that's why hedging and all the other things can be tricky for us. So it provides an insurance. Just in the case of an insurance, you have to own the asset. You have to own a house, you have to own a car, something. In this case, you don't have to. So that's why insurance can be a misleading concept here. Okay, so a company which can go to default, or a country, is the reference entity. Default is the credit event, and total face value of the bonds, practically this is the CDS notional capital. And later on there will be even an approach which says that practically CDS is also operating like a bond. So it has its payments, just it's reverse payments because we have to pay it, and if it's active, then practically the notional principal will be paid. So we can convert it back and forth, and also we have a percentage as well. So this is the CDS spread, so how much money we have to pay and how much money can we earn if the default happens. So that's why CDS spread will be important. The problem that sometimes just CDS spread is just jumping up. But also we can approximate CDS spread, because still if we have the same risky asset, let's say a corporate bond, and also we are taking the same government bond with the same maturity, then practically their difference should approximate the CDS spread. Or not. but it should fluctuate around it. So that's why approximation is happening. Otherwise, buyer of the insurance obtains the right to sell bonds insured by the company for their face value when the credit event occurs. And at the same time, the seller of the insurance agrees to buy the bonds for their face value with, when the credit event occurs. But, so it can be a physical, and later it will be also mentioned by the book, that physical settlement means that if the bond face value was 100, then we have to pay the face value immediately. But in cash settlement, the insurance company can say that, okay, but there is a recovery rate of $30. So after that they are saying that, okay, we are just paying you 70, and to determine this recovery rate, they are saying that, okay, let's run 2 times an auction. So how much, or they are just checking auction data, last known data from the bond market, and they are taking the last 2 numbers, and they are just calculating an average of them, and after that they are saying that, okay, you can recover this one, so here is your money, which makes things trickier, because obviously you cannot trade in real time, or as much in real time. So if the CDS is done, and after that some additional information is coming in and it affects the recovery value, maybe pushes it down, practically we can also lose money. And also it creates a deviation between the risky asset and the risk-free asset when we are thinking about the CDS. So yeah, I'm using my hands, so special effects on the video as well. Okay, so yeah, and periodic payments must be done. So usually these payments are done in every quarter of years. So what happens if before the next payment the default happens, still we have to make the last payment. So it must be finished, so we cannot say that, oh, now the company is going down, so I don't want to pay you anything. Still the last payment must be done before you get paid. Maybe they can deduct it, but the book was quite strict in these terms. Okay, so the cheapest to deliver bond, as I mentioned already, that this is when cash is used for settlement. So somehow they have to define that, okay, how much money can be recovered, and in this case they're just saying that, okay, right now the market is still trading this kind of bonds, and they can emerge. It was really funny in the early 90s when the Soviet Union collapsed, and it was written in 1 or 2 books that even the Tsar Russia government bonds started to reappear, like with a 5% in their face value, but still someone tried to trade with them on bond markets. Obviously nobody recognized them, so several months later they were removed from the market. Just it's really funny that sometimes recovery rates can be affected. Okay, so valuation of credit default swaps. So in this case we can see that there are numerical examples in the book, which can be nice. Just at the same time I don't like it, because it's much nicer if so in appendix K they are not providing enough equations. Already they are trying providing the numerical example, which not that elegant. So hazard rate of the reference entity is 2%. Okay, so we have to use this one, and we are running this CDS for 5 years. survival probabilities and unconditional default probabilities will be provided. So we have to deal with them. So probability of survival at time t. So practically again we have to compute present values. So they are completely behaving like this, because right now this is not an interest rate, right now this is hazard rate, so this is a probability of being harmed, and this is time. So it's still funny that it looks like this way. And after that we can say the probability of default during a year. So what happens if we have one survivor here, one survivor 1 year later, so practically this is the probability of going down between the second and third year. So just the problem is that, okay, but how can we estimate hazard rate? So still we need the data source. But anyway, if we would like to do this in a right way, practically we have to go through the following 3 steps. So we need to calculate the present value of the expected payments. So we have the CDS and we have to pay the money, and calculation of the present value of the expected payoff. So if default happens, then how much money can we get, and the actual payment made in the event of default. So I mentioned already that, okay, after the default happens, still the next payment must be provided, so it must be added as well. So we have 3 steps, and after that the book suggests the following things. So we have to assume that default happens halfway through the year, so in mid-year at least. It makes things easier. Payments on a 5-year credit default swap are made once a year, so at least we don't have to deal with quarterly payments. At the end of each year, risk-free interest rate is 5% per annum with continuous compounding, and recovery rate is 40%. And after that everything is built up like a table, but I think it's efficient if we are. Right now Excel is much better choice than Matlab. Now I will show how can we do this with Matlab, because it has a really nice tutorial and also functions. So we can run everything through, but first let's see the numerical example, because at least in this case we see what happens inside Matlab as well. So recovery rate 0.4, risk-free rate RF is 0.05. Time 5 years. Okay, so we don't have 0 year, just 1, 2, 3, 4, 5, and total. Okay, next thing, probability of survivor. What we learned from the previous slide, so we had just have to do this quasi present value calculation, and no, we don't have this. Yeah, okay, let's it's supposed to be EXP. hate Excel. Why they have to translate everything in Excel? So yeah. And then I did not want it to turn on the English mode because all the class documents for the class is located in the Hungarian folder, and in this case I cannot see the Hungarian folder. So yeah. So partially this is my bed. Oh. I'm doing the wrong thing. Yeah. This is the discount factor. Yeah, okay. Yes, because one thing was missing, hazard rate. Let's do the same thing just now. Numbers are perfect. Okay, we have the expected payment, but expected payment is the same. Just now we can see that, okay, how much assets do we have here? So let's define the S. Let's define it as a 1, and after that we can play with it. Multiplied by S. This is also looking like this, and let's use italics to show that this contains something, just we cannot see it. And after that, present value of expected payment. So yeah, this number multiplied by this number, and after that. So this is the maybe not. Oh. There was an enter inside, so that's why I was not able to see it. Okay. I'm trying to make it nice, just yeah. So we can see that, okay, first table was built up, then next thing, calculation the present value of the expected payoff. Okay, first let's copy this one here before I'm doing any other formatting disaster. Timeline, and then probability of default. So here we can say that one minus probability of survivor will give these numbers here. What? Because yeah, they had to convert everything to half a year. Yeah, but okay, but yeah. But how do they have? So we have 0.5, 1.5. So how do they don't miss a thing? Okay, I have to change the direction of the division, or okay, so in this case we just have to say that okay, probability is 1, and after that it goes down, so just we have to take the differences between the two numbers, and after that there is the recovery rate, which is constant because it was defined by the author of the paper, and after that expected payoff. No. Yeah, because I'm doing stupid things as usual. Because so the recovery rate is already there, as or recovered money is there, so we have to insure the other side, the non-recovered part. So that's why 1 minus 40%. So we have to insure the 60%, and after that we just have the money there. So we can say that Nice. Now, okay, we have the discount factor, and it will be different because now we are talking about partial years. So okay, and then present value of the payoff. Just checking. Okay. So we have the total present value here. It's 5 cents for each notional capital or principal of $1. So nice. Then the last thing, the accrual payment. So again, time scale is this half years because it will happen mid-year, and in this case the probability of default is not changing, so we can say that yeah, this is the same like before, because it would be strange if we would have two different datas. And expected actual payment. Still we have to pay the sum. So it will be half than the so we have to take this number here, the third year, so this is the probability. So this is just half. Okay. So let's define half year. So it's 0.5. Somewhere we should define it, that it's not just coming from the skies. Yeah. And also we have to add the S value, which is right now it's not changing, but in the future it can. Okay, and the expected accurate payment was done, then discount factor. Oh, okay. Discount factor is nice, so then the PV of the expected accrual payment. We're just summing this thing up. Okay, and after that we can see two main components. So present value of the expected payments and the expected payoff. So we can sum them up. So let's unite them. Let's plus this payment, so 4 point. Why are you different? Huh. Uh-oh. So, oh my god, yes. This was not fixed. Now it's okay. I'm not generating random numbers anymore due to scripting errors. And also we can highlight that, okay, this yellow number was coming here, this other yellow number was coming from here. Maybe just fix this here so I don't have to open it multiple times, and then this will be a green one. Okay, I have to save this. And in this case the expected payoff is this is just coming from this number, so nothing new is happening here. But after that we can have the CDS spread of the new CDS, because we have to make a division. So this will be a friendly orange. No. I know this is Excel, but can't I click here? So until then, one component was always contained in these S numbers, so we have to just calculate it backwards. That's okay. We can divide all the expected payoffs payment is payoff, and this is the CDS spread, and we can see that this is the same number what we get. So if someone would like to determine that what is behind the CDS spread, practically we can say that all the expected payments, all the expected payoffs must be recalculated to the present value. But the funny part is that I mentioned already that, okay, but what is the risk-free rate? So practically the risk-free rate will be dependent on the CDS spread. So there can be easily we can find ourselves in a circular relationship. Okay, right here this is not considered in this example. Just in real life, when we know that at the same time the yield of the bond will be 8%, then we would say that okay, but 8% minus this number here, so it's supposed to be 6 point something, 6.8 or 6.7, and this is not 6.7. So practically we would be forced to say that okay, we have to recognize this as the approximated bond yield, or it should fluctuate around this, otherwise we will break the equation. So. Okay, but we have also some nice databases to do this. So we have some credit indices, so that's why we should see that how does it look like, because the book says that there are two main credit default or credit indices which are containing more than 100 investment grade companies, both in the US or North America and in Europe. And practically what they are doing, that in every half a year they are checking that which companies are no longer in the investment grade category, they are kicking them out and then putting back which is investment grade. And also they are determining this for different major maturities, and that's why practically we can see that this is a average or weighted average CDS spread for a portfolio. Now we have iTrax for Asian markets. Also inside Europe we can have many different subcomponents. Also for Asia Pacific, Western Europe. I have no idea what is this one, so let's check. iTrax Europe. And as the book suggests, that we have this main majorities, and here we have 1 year, 3 year, 5 year, 7 year, 10 year, which is the same, just 1 year is missing from the book, but otherwise it's okay. But also at the same time we can see that there are the different bonds. So AXA, Aviva, they are from the financial sector. Aegon is also from the financial sector. Airbus, which is building airplanes and many other things. Alstom, which is building trains. Berkeley, which is company or which is a bank. BASF, which is from the chemical sector. Bayer as well. So and we can find more of them, so we can say that this is also a lot of companies, so it's not just a small. Telenor, it seems to be Veolia Emiron, so it's a utility company. Utility. And also there is description here that what kind of industrial sector is represented. So this access denied is so friendly here. And also we can see their ratings, so everything should be above BBB in S&P rating. And Fitch rating is also, I have no idea what is this, but okay, so in S&P rating, what I know, it should be above BBB, so we can see that, yeah. We cannot see any double B or C or single B here. Nice. Okay, so I mentioned already that CDS or CDS indices are traded like bonds, so in this case the fixed coupon can be assumed to be the periodic protection payments. So the thing we must be paid, and there is the recovery rate, which can be the capital. Just we know that practically this is not the recovery rate, this is the opposite of recovery rate. What will be the capital, because we don't have to. We will recover this one, so the insurance will be on the non-recovered part. So in this case the book was a bit misleading. There is a trade in estimated, the trade is estimated using the specific procedure, so the present value of different payments will determine the spread, as we were able to see that the spread is generated this way, and the payment will be equal to the coupon of the remaining life of the transaction. So also we can understand that one, but obviously the market will deviate from the spread. So sometimes the spread can be smaller or it can be bigger than the coupon. So practically the spread can be bigger than the periodic payments present value, or can be higher or lower. So that's why I was mentioning that this is not that automatic. Asymptotically it's fluctuating around it, but there will be frictions. And in this case what happens, that some part of the difference, or the difference must be paid by the seller or the buyer if there is disparity. And once they are settling the situation, so they are clearing the friction between the market and the theory, then after that the buyer of the protection then pays the coupon, so the periodic payments, and after that they are happy. Okay, credit spreads. So credit spreads are defining the extra rate of interest per annum required by investors for bearing a particular credit risk. And this is where we can go back to the Excel again, because this situation can be also tricky. So this was the CDS spread PV, and this is the credit spread situation. So practically we have to consider the following issue. So if we have any kind of bonds, then there will be the different layers how the yield is building up itself. So first layer supposed to be that inflation should be considered. Maybe it's not an automatic thing anymore, but in the past we had to consider always the inflation. So if we are having different estimated windows, so let's say that for the next 4 years ahead we are thinking about inflation, then practically we can just So today we got the most recent data about inflation, so it's around 6 point something percent, and until the end of the year right now they are expecting 5.3%. So you can say that okay for this year. This is for the next. This is for 2015. And after that we can assume that things are, if the monetary policy is credible, then after medium run, so after 1 or 2 years, inflation should fluctuate around the targeted level in the future. So for the ECB I can believe this. Okay, but after that still we have to see that, yeah, but if you are talking about bonds, then there must be the lowest underlying yield. So let's see that what is happening in the AAA rated sovereign bonds. So if we are checking, let's put the data here that okay, it was coming from this source, but German government bond rating. So if we are still thinking about the Eurozone, then we can see that yeah, German government bonds are AAA rated. So if I'm going back from here, let's clone this one. Oh, come on. Okay, so now we are able to go back, and then asset classes, fixed income, bonds, government bonds, Germany, curves, zero rates, because we would like to avoid any issues. Then we can see that okay, 1 year ahead, this is what we have. 2 years ahead, this is what we have. 3 years ahead, 4 years ahead, and after that we have to change the decimal points to commas because yeah, excellent. And these are these are percentages. Okay, let's eliminate the percentage mark. I cannot eliminate the percentage bars, come on! Okay, I was able to go back here. So 0.0. How to make my life difficult. Or I can do the change, but I know that it starts with a 2. So now it will start with a 0.02. Yes. I can be still lazy. And Germany. Okay, but if we have to think about this, okay, for a German company, after that it would be really simple to say that okay, we have the spread, but let's say that we are looking for something which is not a German company, so France, because they're France, so their credit rating is just triple or double A. And but they are still in the Eurozone, so at least there is no additional foreign exchange rate risk whatsoever. So, so Germany, France. This 3, 2. Maybe I should add more digits. Yes. Okay, so after that we can add a company to this job. So fixed income bonds, but now corporate bonds. And instead of Word, we are jumping to France. Curve these. And still we have to be in AA, because in this case we can have the similar rating, which is important according to the book. Otherwise it will be not a CDS. So, if we need any kind of reconstruction here, then practically we can say that, yeah, so the sovereign spread must be the difference between this asset and this asset. So this is when we are jumping between the risk categories. So from and after that we can say that this will be the credit spread. When we are jumping from here to here. And so also we can use it for modeling purposes, because after that, if we have big enough data set, so let's say that we collected everything from the last 2 decades, and after that we just highlighting that what was the highest sovereign spread, what was the highest credit spread, then after that we can just build up the situations or we can build up scenarios for worst case scenario for funding or anything like this, because we can use these spreads. But also right now we can see that yes, but this credit spread can approximate one thing, and this is the CDS spread. So that's why this thing can be important for us. And also it will be really funny that, yeah, but if we are looking on this data, all the nominal interest rates are, okay, here they are compensated. The inflation, also here we can see that this inflation is also compensated. Okay, this one is, now it's positive. Finally we have positive real interest rates, but otherwise still we can see that, yeah, this is negative real interest rates. So in a perfect world, the corporate bond yield would look like this, that okay, let's add the inflation, let's add the sovereign spread to it, let's add the credit spread to it, and after that it's supposed to be something like this. And these are not the same thing. so if we just if we just highlight the difference, we can say that so central banks biased corporate bond markets and yields a lot with the, all their asset purchase programs and other interferences. Because otherwise, CDS spread provide one measure of the credit spread, what we were able to see. Bond yield spread, corporate bond exceeds the yield of the similar risk-free bond. This is what we tested. And CDS can be used to hedge a position in a corporate bond. So practically an n-year CDS spread, so let's say 5-year CDS spread should be approximately equal to the excess of par yield on another corporate bond over a par yield of a risk-free bond. So we just have to say what happened here. Okay. So we just have to say that, okay, this difference. Yeah, so it was working backwards, obviously. And just again, yeah, but this is absolutely not considering the partner risk. That someone had to write this CDS out, and after that, what is their probability of default? This is absolutely not considered, because it creates the illusion that there is always a scarcity of risk-free assets. So there are not enough good economies, unfortunately, inside the world economy. So in an optimal world, we should have 3 Eurozones and 2 United States at least to provide enough safe access to the current capital market to build portfolios, to at least to create any kind of diversification. So that's why it can be a dangerous incentive that, okay, let's create synthetical protection by just, let's take risky assets, let's buy a CDS to that, and after that it's like a risk-free asset, and then we can add this to a portfolio. What can possibly go wrong? And after that, suddenly when we need the CDS, we realize that, yeah, but the underwriter, they was destroyed during the procedure because there is a crisis and they are not able to maintain their position. So yeah, risk-free rate. CDS provide a direct estimate of the credit spread. Calculate the credit spread from a bond yield. It's necessary to make an assumption about the risk-free rate. Yes, this is what I mentioned, that it can go jump back and forth. That's why LIBOR swap rates can be used as a proxy when we are valuing derivatives. Nowadays it's popular, except we know that the LIBOR will be eliminated sooner or later from the benchmarks, but it's always rumored that they will eliminate it, just it never happens. So there is an example for that. This one. Okay, so we can have the following situation. Oh no, this will be the next one. So we don't have. This is stupid, so let's go back to the. Yeah, because the next thing is asset swap. Then we can practically see that how these LIBOR swap rates are working. So asset swap are providing a reference point for traders in credit markets, because it gives a direct estimate to the excess bond yields over LIBOR swap rates. So the concept is that we have two companies. One is paying the coupon and below the pair value principal, and the other is paying the LIBOR plus the basis. So the, what is this? The premium. And if there is some kind of above pair value principle, then they are also paying that one. So that's why we have this numerical example. So okay, we have three different outcome. So the bond has this pair value of 100, and not just the pair value, but also the market price is 100. So there is no difference. So they're buying at pair value. So in this case, the company A will pay only the coupon of the bond, and the other company will just pay the LIBOR plus the basis points. So practically this one is, yeah, it's paying just the fixed rate, and the other is just paying the floating rate. But the difference that if we are converting everything to CDS spread, obviously we should not forget that, where did I locate this one, that the fixed coupon, it will be the periodic protection payment. So if we are going back to the numerical example, that paying the coupon, this is the regular payments for the safety. And the other will give us some variable interest rate with a nice premium above the changes. So that's why this can be a good indicator, because practically it shows us that what is the conversion between safety and interest rates. And what happens if, obviously the bonds are usually not traded at their pair value, so if we are under the pair value, then also, first of all, you have to pay the divergence from the pair value, so this $5 US, and after that the safety CDS payment must be paid, and you can get the nice interest rate from the other party. And obviously if you are above this, then the counterparty who will pay you the LIBOR will pay you also the above level, or the exceeding amount of money when we are above the par. So it can be a good indicator, because in this case we can jump between CDS payments and interest rates. And the last thing, that if we have any kind of bond yield spread, then it can be related to the CDS spread, and also we can see that, yeah, what is the difference between the bond and the CDS, and we can get this one. But I mentioned already that estimating default probabilities from credit spreads can be a tricky business. So that's why there is another table what we can generate, and this is how we can do this. So what is funny, that the book provides us an approximate calculation and a more exact calculation, and practically they are doing the same thing. So let's focus on the more exact calculation, because so default probabilities. Because here when we had to calculate this one, we just had the hazard rate. So the hazard rate was provided automatically. So Matlab can, or it provides us two applications. One is for hazard rate calculations, and it follows completely the same steps what I showed you in Excel, just it's automatical, and we can define the dates back and forth, and the other one is calculating the CDS spread. So So if we are checking the what is this help menu, so if we are checking the documentation, then we can see that there is bootstrapping credit default probability curve from credit default swap. So this is doing everything backwards. So we can say that okay, let's give the settle date. Let's, as usually in any case when we have to calculate anything in financial toolbox, obviously we have this yield curve calibration, and after that what matters that it will create a financial instrument, and after that it will just bootstrap the probability curve for us. So let's see this one. But if I remember well, I prepared this one already, so let me check my notes, because we can spare some time. Contracts or quotes of CDS indices, and in this case we can see that market spread. So these are the quotes. So market spreads will be generated. Let's copy this way. Generated this way. So these are the spreads, and after that if just compensates it and calculates the present value with the negative interest rate. So we will correct this one, and after that it will practically we need two calibrations. So when the datas are happening and when the spreads and the zero rates are happening, and after that this thing will gives us this beautiful graph. So what happens here? But again, that's why I wanted to show you in Refinitiv icon that this bootstrap default probability is absolutely artificial. So for many countries we can see that this is increasing and it's really high in the future, while at the same time just we did the math and it provided something like this. But this is not a sure thing that within several years countries can go to default. So that's why I don't like. What do we need here? Market spreads? Yeah, just they are in basis points. And I cannot copy. Okay, so $2.72. Next thing is 5.45. Next thing is 8.16. 30. Oh, it's okay for 5 years, whatever. 13. Okay, so this is 1 year ahead. So what we have here is April, maybe. Click. Next year. It would be easier to say that okay, let's just define it as years, but they are better than this, so yeah. Okay, and after that, zero rates. Luckily I downloaded it, so we don't have to do this again. What will be the conversion? It's another question, but yeah. Okay, so it will be divided by 100, so at least I can get rid of the percentage marks. And finally, we don't have negative interest rates and nearly zero interest rates, which is a good thing. Zero dates are the same. Also, it can, why it's much more flexible, that it provides the opportunity to have different maturity dates. So no, and I killed it. How? Okay, it's good. 1, 2, 3, 4. 1, 2, 3, 4. What is happening here in this line? Uh-huh. Then let's check the tutorial. What did I... Okay, so these are interest rates. I'm doing the same thing, just dividing by 100, so it's should be nothing dangerous here. Also, we can say, let's calibrate. Maybe I messed up the April and other things, so calibrate years. We have 1, 2, 3, 5, and after that nothing more. Can you work with this one? No, you are not able to work with this one. Even better. Oh, because zero market dates, yes. Can we make this work this way? But why? Addition is not defined between char and calendar duration days. But they are doing the same thing. Because I need date time. Sooner or later I will do the conversion back and forth. Okay. What is your problem here? Nothing. What's your problem here? It can do. What happened with the year? Okay, So this can be a reason why it was mishapping. Oh, come on. Why? Now we have everything which is supposed to be perfect. Market spreads. Okay, we are in the next step, but so yeah. Market data, market data. One, two, three, four. 1, 2, 3, 4. So it should be parallel. All inputs must be date times or date time character vectors for we have to use, yeah. So we did not allocated this one anymore. Okay, so yeah, 0 times 0 times 0 dates, settle plus calibrated years, 0 rates. Okay, rate curve is generated. Okay, so let's run this one as a standalone, and then we will go back to yeah. Okay. Now we have spread dates. Still the same thing is happening. Okay, the spread is different. Wow, this is a new thing. Date moves. I did not realize this. There is a function like this one, but okay. Settle something. What does it do? It has no idea, but let's check it again. Operator star is not supposed to for date times. Why it multiplied by 12? Ah, because oh, sorry. I did not want to give it to you because it was not there. Okay, so spread times. Settle spread times with the multiplication. But why it's multiplying the years? So let's eliminate this. We don't need. So this is a specific number. One, two, three, four, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. Ah, this is a different direction. Yes. Why? We have the calibrated years. Okay, this one is inverted or transposed. This one is also transposed. We have the settle date. The settle date was defined well because we use this one. Datetime function, it doesn't matter that we are using double quotations, it will give the same result. So yeah, first argument must be numeric, logical, or character array. First argument, so settle. But the settle is the same. Come on. Datetime settle. Right now this CDS is quite cursed, but because after the spread times it's just vectors, who cares? I have no idea why this is not working. We just need these things. Settle spread times. Practically doesn't need even the spread, just settle and spread. Because even if we are avoiding all these troubles, then we are saying, okay, CDS, contract spread, BP. Yeah. This is where it also fails, because we need this stupid non-market instrument, and this non-market instrument will be generated from the length of market dates, and it will be just 4. Let's try to bypass this variable. So what happens if I'm just using the length? So the length is always measuring the biggest dimension, so it doesn't care that what is inside. So spread times. Can you deal with this one? Yes, it will be 4. Okay, sorry. And then contract BP. Practically we don't need this kind of variable, because we can just put it here. Yes. Maybe we can eliminate this one. Right now I don't want to. No, because it later we refer and use. So okay, let's get it back to nature. Okay, so contract spread. Okay, market dates. Stupid market dates are still here. What is this function? Start date number month. Oh, yes. That's why we have to multiply it with 12, because number of months are necessary. Did we solve anything? No. Oh my, because I'm it's defined calibrated years functions here, and that's why it added the epsilon, and that's why it's so it required numbers. Sooner or later I will. Yes, now the market dates works. Okay, then length of the practically doesn't matter it's spread times or market days because it will do the same job, so it's still 4. But now it has done something. Okay, and after that here something is, it runs against the fin instrument to create stuff in the market CDS instruments. So yeah, because at the beginning we just prepared it and now it should do some kind of fitting. Okay. And then this is the best part, the default probability. Zero curve market CDS instruments and the spread. We have the spread. Yes. And then the hazard rates are provided. But default prob curve should have some kind of graphical representation. Yeah, so these are the probabilities. Just in the past it had something and now it doesn't. Yeah, so we can imagine that. Okay. What is your name? No, let's go back. At least they give a long name to this one, so but now we can see that yes, it still follows the desired trajectory. And then we get the hazard rates. So practically we have, let's calculate hazard rates. Okay, default probability curve, then one line of function without any kind of switches. So yes. Once we are able to load in the 4 line of data practically, or even we would eliminate practically spread years could be added here automatically. No, because this one is already transposed and this one is not, but so even we could reduce it to 3 lines of codes. 1, 2, 3, yes. So if it would be precise enough. Okay, hazard rates. Now let's see, how does it look like? You can see that, yeah, we got hazard rates, it's also non-zero and it's changing, so it can be nice. And survivor probabilities. Okay, this is so default probability curve, and okay, we can have a designated function for that as well. Just I can't see what is the added value, so because this is just the other end. So yeah, falling. Cool. So even in the case of France, practically we can see that there is a probability of default of 1% within 5 years, because this is 5 years, it's not 4, and that's why I can say that yes, mathematically yes. From macroeconomic point of view or from macro financial point of view, this is utterly nonsense. So we have no idea what is the internal and external debt of the country. We have no idea what is the currency distribution of the debt. So is this completely denominated in euros or in US dollars? Nothing is provided here. So this is just pure mathematics. That's why I don't trust this. Sorry. So when I was a university student, I spent 3 years at the economic psychology department as a trainee, and I learned some skepticism with financial models, because usually when people are overconfident in these things, then that is never ends well. Okay, let's go back. Because there was also a CDS pricer. Yeah, okay, let's hopefully the other one will work perfectly. So yeah, first of all we have to clear this thing out, and then practically we have to fill it up with data about the CDS, so the underlying assets. So what will be the maturity, what will be the spread, notional, so how much money is at stake, and what is the period of payment, basis of payment. So practically we just have to fill it up as a bond. So it's nothing special at this part. Then we have to specify the settling date, because here we just have the maturity, and again default probability times the default probabilities, which is given right now. So this is the funny part, that okay, here we have the CDS spreads, so we have to know the CDS spreads, or if we don't know the CDS spreads, we have to know the default probabilities, or at least we have to download the averages from the market, and then we can have this kind of data. Just it's so circular. Then we have to create a rate curve object with the yield curve, and at least there are no negative interest rates, so they are close to 0, but we can see that these are percentages, and after that things will happen. So let's see, from object to object, does it want to run? And at the end of the day, so this is the price of the CDS. So so some kind of present value, and this is definitely not the CDS spread. This ACR premium, this is the actual payment, so this thing is this. But price CDS, so this is output peer swap. Yes, payment CDS. So these are the, this is what we are looking for. So these are the, this column, and payment dates, payment times, so it doesn't matter. So it's quite dumb, relatively, to be honest, because at least in the Excel sheet we were able to get exact things and not just what is the price of the CDS. So the expected payoff is also not, so yeah.